where we get to complain about regulators before they get here. I wanted to start, we're going to set the stage for today's conversation, and I wanted to start a little bit about what you've learned over the past few years, where you think, how sort of, don't reminisce, but think about how far fintech has come, and then think about where things are going next. And I wanted to start with the two, I can't really call you upstarts, the two disruptors. And Sarah, perhaps with you, I think it was 8 years ago that your little white reader appeared. Tell us how different things are than you expect. I mean, can you remember 8 years ago? What did you expect Square would be doing in 8 years' time?
Yeah, so I'm 5 and a bit years in, so I'll start from there, but that still felt like early days. So you're right, we started, we always say we really learn from our customers. It's all about ultimately what they need. And at the time, we thought it was helping them take a payment. In reality, it was actually making sure they never missed a sale. So kind of that was the starting point of Square. 8 years on, we're still thriving, growing at a pretty hefty clip. We grew last quarter a little over 40%. We're now seeing about, on an annualized basis, about $60 billion go across pieces of hardware, but also through software. We have a lot of software products that help sellers, help our customers make sure that their businesses continue to grow. So that really puts us on par with a top 10 US retailer, if you think about all of those small businesses that we're aggregating. For us, it's been about what next can we do to help those businesses thrive, and that helps our business thrive. So we've gone from help me never miss a sale to help me manage my business. We recognized along the way that we aggregate a tremendous amount of data, and that really ultimately is the underpinning secret sauce in a way. And utilizing that data, we can continue to do more and more interesting things for them. So we have branched into areas like Square Capital, so making sure they get access to capital, things like CRM solutions to help make them more customers come into their businesses, help them upsell and manage their customers. And then we've begun to shift more towards the consumer as well with our Square Cash P2P product. So lots going on across the board. I certainly always dreamed Square could become the scale that we're at. Clearly, we have big dreams over the next many decades. Jack actually talks about the 5,000-year company, and we can talk about that too.
The 5,000-year company.
The 5,000-year
that's
company.
more than, it's usually Chinese leadership that talks in millennia.
So 5,000, it's an interesting positioning, because it means you have to build a company that will go on long after all of us are gone. And that's kind of the thinking of it. But really, it's about how do we bring more folks into the system, really speaking to financial inclusion.
So you've raised a number of topics we'll come back to, particularly the importance of data, which is, I think, a theme we'll hear a lot of today. But Scott, are you going to be the 5,000-year company?
That's a great question. I think if I'd like to be around for the full 5,000 years is what I would say. So to your question on where we've come, we've been a decade in business. Our first loan was in June of 2007. And we have grown to become the largest provider of personal loans in the country. And where we take the business next is really what we have tapped into, going back to what's the customer benefit. What we've tapped into is really helping people manage their financial lives. So the key benefit of our core product is, close to half of Americans have accumulated credit card debt. We're saving them about 24% off of the rate they're paying on their credit card debt, and we're moving beyond that. We launched an auto refinance product for most consumers. That's their second largest purchase, is their auto. So same thing of, you could be paying too much. We get people the credit they deserve. Look beyond some of the traditional means, using some of the data available to us today to really better assess credit and better extend.
Did you expect to have grown this fast, faster, less fast? When you had those, I'm sure every founder and their team has a kind of, chart which you have to show to the VCs, which has to be exponential and has to kind of go for like that. Have you kept up with it?
Yeah, my story, so I've been with the company for 7 years. I actually talked to the company 3 times before I joined. I always believed, looking from the outside, that this was a very powerful idea. This idea that, hey, a more efficient way to connect users of capital with the source of capital And I believe that well executed, this could be a truly massive business. I think what surprised me was the pace of change that we were able to bring about, that we were able to go from individual investors lending out to individual borrowers to now, close to half of our funding coming from banks and other institutions. So that pace has surprised me.
So Vanessa, there are two companies that didn't exist just over a decade ago that are now nibbling or perhaps gobbling away at bits of what incumbent banks are doing. How do you view the last few years, and do you see it as a kind of a threatening time for you, or has it been an opportunity?
That's a great question. I mean, I think in the 5,000-year time frame, 205 years feels a little bit like a startup. So that's, we watch a lot of trends and participate in a lot of trends. The way I think about innovation in finance, or frankly anything else, is that what happens is the whole frontier moves, right? So I don't believe this is an era where just startups or just established new companies are moving. Everyone moves together, and the reason for that is, entrepreneurs will tell you, if you have a great idea but you're way ahead of your time, you're kind of out there, there's no ecosystem around you to support you, and many times those ideas don't go anywhere, even if they were great ideas. And I think what we've seen over the past 5 to 10 years is a push across all of financial services, both incumbents and newer companies, paying attention to not only technological changes and what that means for our clients, but behavioral changes and what that means in terms of the kinds of products and services that we can offer. And also just, an almost a complete redefinition of how we think about what industry each of us is in. So this is the Fintech conference, but in some ways, we brought about some change that says, it's not just banking. You think about how do you take care of your client's whole business life, right? You think about how do you take care of someone's entire financial life. It's a much broader look at how we can serve clients. And so I believe that those three changes around technology and behavior and sort of industry lines are propelling everyone forward. And we've done a lot of work at Citi, in particular over the last several years, to realize that there are great ideas that come from companies that none of us have ever heard of yet. There are also great ideas that come from people who've been in banking for decades, because many times they understand what our clients' biggest pain points are and how we can serve those. And so we've taken a page, I think, from what entrepreneurs do and really tried to bring that into a large, global, 205-year-old company in order to make sure that we're doing the same kind of challenge for ourselves and what we can bring as entrepreneurs do every day.
Are you able to do that? I mean, you have this fantastic title of Chief Innovation Officer, which is a very cool title. Who wouldn't want to be Chief Innovation Officer? But it does remind one of the innovator's dilemma. And it strikes me that I'm sitting here with two representatives from companies that are founded to disrupt and that have both disrupted very successfully. And the kind of traditional rap on incumbents, and we're incumbents in our own business too, is that we may want to innovate, and we don't have a Chief Innovation Officer, we probably should do, but it is hard to do. And you look at, these guys are focused on one thing, and they're well, now more than one, but they're coming in and focusing on that. And for you, if you're 200 and something years old, are you having trouble getting the rest of Citi to kind of see that this is important? Do your customers want this innovation? How do you push forward?
So no, we're not having trouble. I think it's very clear in today's world that our clients both want and demand innovation. But the way I think about the balance that's at the heart of your question of, how do we run this large, important business and think about innovation is really critical, because, Citi is a company that moves trillions of dollars around the world every day. And I always liken this to, if you're going into surgery and, it's not your most proud moment, you're on the gurney wearing kind of what feels like a paper towel. You don't want your surgeon to stop by and say, Sarah, I was thinking I'd try something new today. Because in that moment, all you want her to say is, I have done this thousands of times, And I assure you that there's no variability here, there's no volatility. We're going to do this the same way we've done it before, and you're going to walk out of here this afternoon. And that kind of thing characterizes a lot of our business, where that assurance and safety and security and ability to deliver flawlessly is really critical. And as you can imagine, that mindset is a really important part of how we deliver across the world. And it's balancing that mindset and that set of behaviors and that set of policies at the same time saying the world is changing very quickly, technologies, behaviors, et cetera. So how do we infuse the same kind of curiosity and ingenuity around what needs to be experimented with, while not saying, well, that means we're just going to do everything differently, because there are core pieces of our business that need to just operate on a business as usual standpoint all the time. We've actually, we think we're making a lot of progress toward being able to infuse the characteristics that entrepreneurs have and experimenting in a very constrained way, right? We can talk later about, the whole Silicon Valley failing fast. We think about how do you experiment in a constrained manner where you can learn things and embed them, rather than kind of put the whole business up for experimentation, which doesn't really work in our world.
That's an interesting segue to ask the two of you how you do that now, because move fast and break things is the kind of, a mantra, but, perhaps you have broken a few things en route, and, how do you now think about that kind of innovation, particularly, and Sarah, let's start with you, because, Square Capital, what's the discipline that you have about what you do next?
Sure. So we actually always start by understanding what the customer struggle is. And the only way to do that is to be actually out there talking to them. So we drive it very proactively through insights, so out there speaking to our customers. Clearly, we're speaking to them every day via support channels, account management channels, sales channels. But how do we get all of that information in to understand what they're truly struggling with? So I think the operating table is an interesting metaphor, and I don't want to drag it out too much. But for a lot of people, they can't even get into the operating theater, right? They're completely off the system. And so that's a huge part of hearing their struggle and recognizing that, for example, in a place like Square Capital, we're really proud of the fact that 54% of our Square Capital loans go to women. If you look at the backdrop in the economy from the SBA, it's 16% of loans go to women. So it's a great example of something I'm personally really passionate about. So I think that's one thing, is insights. You do need to be careful when you innovate, because your customers won't always tell you everything that they may need. They'll ask you, for a better buggy whip, and they won't recognize that there's perhaps a whole new innovation coming. So it needs to be blended with also just creativity and inspiration within the company. But I think you start with the customer struggle, and then I think from there you really have to we don't really hold on to the move fast and break things mantra. We talk about taking principled risk. So you have to understand where the risk is in what you're planning to do, but have a principle behind it. It's not just a random risk-taking environment, but understanding that then with that, why you want to do it. So if you think about in the beginning with Square, we onboard over 90% of sellers who come to our website, knock on the door and say, hey, I want to get on the system. It's very different from the industry. Onboard's about 60%. To do that, we had to be really sharp on risk management. You're going to talk about data, but we do that with, today, deep learning, machine learning to deep learning. And that was a risk to decide to do that. That's something we had to persuade the other players in the value chain that it was a risk worth taking, and I think we have proven that out. And so every time we innovate, it's understand the struggle, really think about what the customer is asking you to do for them, and then combine that with a principled risk stance.
Can I just make one comment on understanding the customer quickly? I think this is something, in any big company, everyone talks about being client-centric, right? So that's no surprise. What we've found, and where we've taken a lot of inspiration from Silicon Valley, is that when you're very small, what you need to do is be out, and you're kind of constantly out. You probably don't even have an office at the beginning, so you have no place else to be but out. And as you get bigger and more established, you end up sort of the inward focus takes root. And so while the mantra has been client centricity across the industry forever, I think we've worked very hard to say, let's go back to the roots of what it means to validate that client struggle. And I think that's a critical thing for incumbents to understand.
Thank you. Scott, how do you think about this? Principled risk-taking? What's your mantra now?
So what I'd build on, obviously, starting with the customer problem you're solving is critical. The other piece is you have to create a culture that enables the innovation, and I think something that is not unique to the Valley, but certainly that the Valley has done incredibly well, is breed the type of people and the environments where people are pushing for a solution. So if you look at Lending Club, we have quite deliberately, from the beginning, staffed the company with a mix of people coming out of, the Googles, the PayPals, together with people coming out of traditional Main Street banking and Wall Street, and they're understanding, how have things always been done, with people saying, well, why are they done that way? Could we do it this way? Well, not exactly. And so you take something like machine learning as an example. This is very real, the power that machine learning can deliver. Credit is inherently a data problem, right? It's inherently a data problem. How do you know who to give credit to, and how do you assess the risk of that? Is machine learning incredibly powerful at helping you assess that? Absolutely. But how do you square that with the regulatory environment where you need to be able to tell people, if you can't give them credit, why not? And what can they do about it? And the answer can't be, because my model score for you was 0.0998. So figuring out how to connect this innovation with the operating framework that we are all in as highly regulated entities is really a critical part of the success.
So we've had two of you mention data and machine learning, and I want to get onto that. But Scott, I can't go on without asking you about, because since we mentioned culture, you've arrived back after a pretty tricky time at Lending Club. How do you view that, and do you view it as a sort of an unfortunate blip, or is it something? I mean, from the outside, there is an argument that this is sort of, endemic is too strong a word, but it's now becoming pretty much of a pattern in Silicon Valley in different ways. How do you ensure a culture of trust, which is so central to financial services?
Yeah, so what I would say is, for our business, the entire business is based on trust. Our loans, we've funded close to $30 billion worth of loans. Those loans are funded by investors. Transparency has always been key to our business, is letting people know what they're investing in. A little over a year ago, we had a stumble that created a break in that trust that we needed to rebuild. I'd say, within about 9 months, we had all of our investors back on the platform. We built trust with our investors, with our partners, with our employees, frankly, as well. I feel like it was a very important learning moment for the company, but I feel great about where we are today.
Scott's been talking about the stumble in Lending Club. We've been talking about culture, and we're now going to move on to big data. But before we do that, what's your sense, as someone who is obviously a distinguished former regulator, but who's kind of thought about the sector? Do you think that there is a sort of culture issue, a trust issue in the fintech startups?
Yes, I think there has been. I think that fintech tends to march to their own rules, that it is a new industry with lots of failures and lots of spectacular successes. But regulation very often is kind of background music. And the prevalence of scandal and mismanagement and aggressiveness, I guess, is part of the backwash of innovation, that very often the fintech entrepreneurs believe that they march to their own rules. And as a result of that, it is hardly a day that goes by where there isn't some recording of a scandal of one kind or another. I think that's generally true of emerging markets, emerging cultures, emerging standards. And I think that that makes the odds of winning much less than in well-established companies with better established cultures.
Thank you. Well, that's yes. No, I can see you want to jump in. This is a very, very good provocative statement. So, is it endemic, and does it mean you won't win?
So I'd like to just first of all say we are regulated, right? And there are many companies that have been regulated from day one and have stood up to that and done what we need to do to ensure that we are taking principled risk, but are growing our companies in a way that is really good for our end customer. Remember, we talked about financial inclusion, totally disrupting and changing a system that has not allowed for a growth of the economy, for small businesses to take off, for example. And I want to remind the audience that this every day that goes by, I mean, I lived through 07, 08, and 09, and as far as I can see, large established finance companies did not come through in any way looking remarkable. And so
that's a diplomatic understatement.
So I just want to, I think it can become a sea of generalities when actually it's really about precision and ensuring company by company as we grow that we're doing it within the right regulatory environment, but that regulation doesn't become the laggard that stops what we all want, which is a much stronger, healthier economy.
Yeah. Vanessa.
I would just underscore that. I mean, we, as part of what we do at Citi Ventures, we invest in companies, and so we meet thousands and thousands of startups every year. And to the point of generalities, right, it's absolutely true that some of them are not paying attention to regulation, but the lion's share of companies we see, particularly today, are companies that, while they might not have 5,000-year aspirations, they have aspirations to be, thriving and vital participants in the system. And so sometimes there's a lack of knowledge, right? In fact, many of the companies that we work with, we may help because we have been in the regulated space for such a long time, and we have a sense of, well, first do this, then do that. But I think it is important to recognize that most entrepreneurs, at least in the class of people who are trying to build lasting companies, are entrepreneurs who are cognizant and aware that even if at the very beginning when they're so small they might not fall under as many regulations, that they aspire to build their companies and know that that will be the case over time. And so I think it's a good reminder for all of us that both being in the frame of a regulatory environment, but also in the frame of things are moving so quickly, right? Technology is moving so quickly, and our client needs are shifting so quickly, that how do we all, small or large, behave in a way that we best serve those client needs moving forward? And we do see that across the board, irrespective of size.
Scott, you wanted to jump in.
Yes, I do. So I think we're mixing a couple of things. So first, the question is on regulation. I would agree with you, Sarah. I mean, we issue securities that are registered with the SEC. We have, as I indicated earlier, banks as partners who are buying our loans. Our loans are issued by a bank and are therefore subject to all the same protections and consumer-facing protections that a bank has. And they're there for a very good reason. And I think we all need to recognize that. Are there challenges? Absolutely. The OCC was created by Lincoln, right? Things are moving very quickly now. How do some of these frames keep up with the changes that are happening in a way that serves customers and serves them serves them well if you look at in the case of our business. I think separate from that, there's a question of governance and corporate governance. And I would say, not unique to fintech. I think the Wells Fargo story is continuing to play out, so that's worth bringing into this conversation. But I do think we need to take responsibility in the Valley where there is a mentality for growth and growth at all costs. And if you don't have the right checks in place, you don't have the right kind of board in place that is people with audit and risk experience and that are providing the right kind of governance, you can have problems.
It's very difficult for many of these startups to attract the kind of quality board members that larger, more mature companies are able to attract. And very often in the startups that I've been associated with, they have a difficult time getting board members, qualified board members. I think a potential board member has to be very, very careful. Going on a board is not a really desirable thing to do. I would discourage friends or clients of mine from ever going on boards. And
What, you mean broadly or particularly of fintech startups?
broadly.
Broadly, okay. So that's possibly a function of regulatory changes, of changes in terms of expectations and
It isn't worth the risk.
it's exactly.
But that's a shame, because that's exactly how we will cause change to happen, is when we step up to the plate. And so I agree, boards are tough going in this day and age, and there's a big difference between public company boards and private company boards. I think in the early stages, private company boards are intellectually much more challenging because they're really dealing with survival. And as a board member, it's actually super fun, I think, to be involved in the strategy creation and in the execution and helping them build. And I think if I look at a board, like our board, early on we brought on David Vinier from Goldman, and we benefited so strongly from someone who had lived for decades within the financial regime.
Did Goldman have a stake in the company?
No, they did not. He came on as our lead, and he's still our lead independent director. Mm-hmm. And I think that the selling point there is just to really get involved at the grassroots with change and the pace and the excitement that you see. I think on the public company board side, I think we need to find a better balance where they can become so much about just really governance and checking the box, which is important, but you leave no time for actually the creativity and the kind of intellectual stimulus that a great board member brings.
On a private company, I would really want any director to have a stake in the company.
Really? I think you need both. And I think most private companies end up with both, right?
Can we leave this one there? It's a fascinating conversation, but we can have a separate conference about corporate governance in startups more broadly. We've got to stick with fintech. And I wanted to bring up the other side of, you made that very interesting and absolutely correct division about one thing is about corporate governance, the other is about regulation. Sure. We do, Arthur, have a regulatory framework. I didn't realize it was the OCC was set up by Lincoln, but it's a pretty aging regulatory framework. Is it fit for purpose in an era of the fintech revolution? And what is the one or two things that are most important to change?
I'm not sure I understand your question.
Is the regulatory system we have in the US, the financial regulatory system, fit for purpose in the era of fintech? And what is one or two things that you would put top of the list to change? Regulation
always trails the space that the market is in at a particular point in time. Regulators are always playing catch up. So no, I would say regulation today trails the fintech world and very often presents impediments and costs that are unnecessary. Regulators are constantly protecting their space so they don't get caught up with a scandal that they're held accountable for. So there's a tendency to over-regulate and raise costs, and so that's my response.
And what would be top of your list of things to change? In terms of, forget political feasibility, but just what would be the one thing that if you could wave a wand you would change, given your...
That regulators keep uppermost in their minds the one word, and that's balance. Balance between the imperatives of protecting markets and protecting investors, as well as nurturing those companies that are being regulated with sensible, cost-effective guidance that protects both the companies and the investors.
Scott, what would you want to change?
Gosh, I gotta.
So many things.
Yeah. Look, I would say I'm really encouraged by the conversations that we've had in Washington. I would say there's, and I'm speaking quite broadly, I think there's a real understanding of the value that's being driven by companies like Lending Club. There was recently a study issued by the Fed showing, hey, we using our public data, we are making credit more available and more affordable in places, especially where bank branches are closing. And that, information like that is flowing. The regulators are seeing it. They are engaged. They understand our model, and whether it's the OCC, the speech that was recently given, but also their general exploration of potentially a fintech or a non-depository charter, I'm very encouraged by. So I would say, granted, would love to see things move maybe in a faster fashion, and I would love them love a little bit of clarity on who to be talking to where, but I do think that the sentiment of support is strong. I do think there's a recognition that good things for the consumer is happening, and I'm optimistic.
Good. Sarah, I just wanted to ask you, because you're applying for an ILC charter, which will change your regulatory requirements somewhat. What would your answer to that be briefly, and then I'm going to open to questions.
Yeah, I think on the somewhat is the answer to that. So the ILC will be for the portion of our business that is lending, Square Capital, which is a small portion, still sub 10%. It will bring us closer to the regulator, in this case, the FDIC, and it's actually a step we want to take because we want to be closer to that regulator. I think ultimately we're talking about humans, and the more we can get face-to-face conversations, I would agree with them. That's the right way to strike the balance. Today, we do run on top of banks in areas like payments, where they are regulated by the Fed. They are bank holding companies. It doesn't make sense for us to be fully regulated because so much of our business is not banking in nature. So the ILC is a way for us to get closer to regulators. We think that will speed up a pace of innovation. And frankly, we kind of welcome that. Sitting in my role as CFO, it's absolutely good to sit with the right structures in place that allow you to go fast, but with the appropriate mechanisms to keep Square and the system safe.
I think something's been alluded to here that's really important, which is, the startups or established new companies do a lot of work with banks. And so if I had a magic wand, something that we think about a lot at Citi, we call permeability. Right? So it's no longer accurate to say, like, this is just the institution, it does its thing, and then you're the institution. Right. The number of partnerships and places where small companies, big companies are working together to deliver the best for our clients, sometimes our individual clients, sometimes clients that we share. That landscape has changed, I think, quite significantly over this initial wave of fintech, in that at the beginning, most fintechs were adamant about kind of going it alone, and as the landscape has matured a bit, there's a lot more partnership, and that getting that right and understanding what the regulatory framework is and what the operating framework is for allowing those kinds of partnerships to enable better service to our clients, I think is an important shift sort of over and above just
having
the balance
the institutions
of regulation.
themselves. That's a great point.
There have been some concerns, especially in the online lending space, about the entire customer credit models, and I guess all the technology, machine learning, deep learning, all that is used to kind of curb those risks around that. And Lending Club has recently came up with a new credit model, and you guys have said that you're kind of going towards less risky borrowers. So I was wondering, is this kind of a way to kind of mitigate those concerns, and what is your kind of view on that entire space, and how are your investors reacting on that shift?
Great question.
So
Thank you.
when you say concern, are you just talking about the general credit environment and what's happening more broadly? Is that what you mean by concern?
Yeah, I mean, a lot of the players in online lending space have been saying that they're going towards less risky borrowers nowadays and are not going as deep underbanked than before.
So, taking a big step back, the state of credit in the country today is worrisome for a lot of people. Incomes have been stagnating for decades, yet housing costs are going up, education costs are going up, healthcare costs are going up, and more people are taking more and more of their income and putting it towards debt, and that debt is less and less likely to be a home where you're building wealth, and more likely to be credit card, auto, student loans. What the role that we're playing is looking to help people lower that cost of debt. What we've been seeing is what I think most people now are saying is a normalization of the credit environment after an extremely benign period following the crisis. I think the new normal is slightly worse credit performance than prior to the recession, and we've definitely been seeing in higher risk segments that people have been taking on more debt and are starting to go beyond their capacity. So for us, I wouldn't say we are moving away from risky segments so much as we're looking to continually get better at getting people the credit they deserve and looking beyond their FICO scores. Half of America has a FICO score below 680. Gen Xers, my generation, I think the average is around 650. And millennials, it's like 625. Those people try getting an unsecured loan from a bank with a 625 FICO. That is very, very difficult. So we very much are looking to serve that spectrum. But the models need to evolve. Credit is organic. It's changing all the time. And so our most recent model is reflecting the most recent data to make sure we're making the right decisions.
Can I just ask you, and perhaps both of you, a follow-up on that, because the subject we were going to get to was how you use your data and machine learning. And let's start with you, and particularly on the credit side. You began by going beyond where traditional lenders would go, or based on different kinds of information. Now that you're getting further and further into using your data into machine learning, is that going to broaden the universe of people that you lend to, or is there a risk that actually you double down, and in some sense, to paraphrase the questioner, that you become more risk averse?
No, we're always looking for ways to say yes to more people and to do it responsibly. And data is part of that. Also, product features are part of that, right? So can I give you a loan? Is there someone who could co-sign with you? Could I give you a loan? Well, can we use some of it to pay off your existing debt? Like, what things can we do to sort of better, what tools can we give you to make you more creditworthy, in addition to what's the data we can use to better assess you?
And we thought, when we kind of didn't use FICA at all coming out of the gate, we said, if we can see your business, so we know are your payments effectively rising week over week, month over month, year over year, can we see how you're comparing to, if you're a photographer, how do you compare to the other 10,000 photographers in the US? We can see things, because now we run your whole business, like, is your inventory running stale? Are you having to discount in order to sell it off? Are you adding employees, or are you letting employees go? So the signal that we have on your business, we think, is actually much more real time in nature, rather than going back to something that feels a little backward looking. And I think there's a systemic bias that I think can come through with kind of an older school FICO scoring that can just keep repeating itself. And so if instead what you want to do is have, in a way, the fairest possible system, you base it on what do the numbers actually show, rather than what has a system decided your score is.
So there's a great follow-up question just come through on the app on that to you. You talked about, Sarah, about listening to clients as central to strategy development.
Yeah.
What tools are Square using to mine unstructured data, voice, chat, etc., to identify themes and areas of opportunity?
Yeah, this is a great question. So we are spending
Did
a
you
lot
plant
of
it?
time, no, but I love it, because if you knew what my weeks looked like for the last probably 9 months, you would know that in areas like support, we're really trying to make sure that we can utilize calls that are coming in, be able to voice recognize so that the data itself can be effectively printed, and then computers can read it to look for what are the changes and the tone coming. And so that might not just be about things like risk underwriting. That actually can be about how do you create seamless experiences where your customers are immediately answered, perhaps by a bot rather than by a human being. It's not about trying to fake it to your customer that it's a real live person. They can actually be really comfortable with the idea that they're talking to a bot. Some people just want to get their answer and go. The last thing they want is to get on the phone with someone. Like, that's me. And so there's so many interesting things we can do with machine learning to say, okay, we can see that you're on your dashboard. We can see you were looking for your deposit. We know it's the ACH system is off for the weekend and for Columbus Day, which no one ever remembers. So we can let you know that, don't worry, the funds are on your way. They'll get there on a Tuesday. But then at that point, we can even upsell a product like Instant Deposit and say, hey, but if you need them right now because you're a bar and you need to pay your bar staff on a Saturday night, boom, here's a product that actually will make your business even more efficient. So all of that can be done without ever a human being getting involved in the flow. That can all be done through ML.
Amazing. A question which I'm going to give first to Arthur and then probably to Scott, which is, while it's argued that regulation impedes innovation, couldn't it also benefit one startup versus another and act as a catalyst to create competitive advantage? Case in point, Prosper versus Lending Club, and how going through the regulatory and registration process helped Lending Club leapfrog Prosper. So perhaps, Arthur, you answer first, and then we'll go to Lending Club itself.
Again, clearly the word is balance. Regulation hasn't ever kept up with the pace of business development. We see it, and I don't know how much you've discussed this in the panel before I came, but you see it most specifically in the world of Bitcoin. How do you regulate that? How far behind are we? What is the role of states versus the federal government?
So I'm sorry to interrupt you, but we do have a question that came up on that, which we haven't talked about Bitcoin at all, but there is this question, which is the Bitcoin Investment Trust withdrew their SEC filing this morning. How can a digital currency receive the oversight and regulation the SEC desires when the SEC is not acting?
Up to now, it's been the states that have dealt with this issue. I'm not sure that the SEC is ready to take that on at this point. They've got so many competing tasks to undertake right now. I don't think they're equipped to deal with Bitcoin yet.
But should they be?
Yes.
That's a big...
Clearly they should be. I think the tendency of the commission has been to stay away from Bitcoin. They have too many other issues that they're dealing with now that they don't want to take on something as complex from a regulatory point of view as Bitcoin is. And they don't want to get into a battle with the state regulators whose purview has been Bitcoin up to now.
Scott, just on the question before that, the balance between benefiting from regulation or being hampered by it.
Yeah, it's a great point, and it's also a great example of innovation, right? Lending Club, the model is, we identify borrowers, assess their creditworthiness, assess risk, price it. The loans are funded via investors. Well, Lending Club worked with the SEC early on to fit that into a regulatory frame. I think that did require, a massive amount of work on both sides to come to a place where that could happen, and that did create distance. It created an advantage for Lending Club, where we were able to continue growing. And I would say, the same thing is true of the events we recently went through, which is, we went through a massive period of investment in our governance, in our controls, in our systems, everything from data security to access management to, reporting overhauls. All of those things, what that created amongst our clients was, wow, we thought you guys were pretty good at this before. Now you're light years ahead of everyone else. So when it comes to institutional investors and banks, they actually gives them a great deal of comfort that we've come through an event that required us to really double down on our investments.
Which suggests that you've been through the stumble, you're rebuilding the trust, and then things look better.
And it's an advantage on the other side.
An advantage going forward. Well, that seems a suitably optimistic note on which to end this panel, which has set the stage fantastically. There's loads of other questions. I'm sorry, the red light is flashing. But thank you all very much indeed for really setting us up well.